Bonds are sold at their market price, which is the present value of the interest payments that the bondholder will receive while holding the bond plus the bond principal paid at the end of the bond's life. Two interest rates work together to set the price of a bond. The stated interest rate determines the amount of cash interest the borrower pays each year. The stated interest rate is printed on the bond and does not change from year to year. The market interest rate, also known as the effective interest rate, is the rate that investors demand to earn for loaning their money. The market interest rate varies daily. A company may issue bonds with a stated interest rate that differs from the market interest rate due to the time gap between the decision of what the stated rate should be and the actual issuance of the bonds. So here's what's going on. We have three different scenarios. We have decided to sell a bond, and the bond is going to pay 9% interest. This is the stated interest rate. In other words, this is printed on the bond. It can't be changed. Now, several months could go by between the time we choose this 9% interest rate and the time that we sell the bond. So in this scenario, our 9% bond is being sold at the same time that other bonds are also paying 9%, and the bondholders are demanding only 9% to loan their money to us. So in this scenario where the stated interest rate is equal to the market interest rate, the maturity value is the price that people are willing to pay. In other words, people will pay exactly $1,000 per bond. This scenario is not all that likely to happen. Let's look at another scenario. We have decided to sell a 9% bond, but by the time we get around to selling or issuing the bond, interest rates have risen. So bondholders are demanding 10% interest rate. So who wants to buy our 9% bond if they can buy other bonds that are paying 10%? Well, to get someone to buy a 9% bond when others are selling at 10%, you have to lower the price. In other words, the bondholder will only buy this 9% bond if the price is lowered. This is called being offered at a discount. In other words, the selling price is below maturity value. So instead of $1,000, maybe we only got $950 per bond. In the last scenario, we have chosen to sell a 9% bond, but by the time we get around to issuing the bond, because it takes a lot of work and time and effort to get the bond ready to be sold, bondholders are only demanding 8% interest. So who wants to buy our 9% bond when other bonds are being sold for 8%? Well, a lot of people want to buy our 9% bond, so much so that they will pay a premium. In other words, above the maturity value of $1,000. So instead of $1,000, maybe they're willing to pay $1,090 to get our 9% bond when other bonds are only paying 8%.